The global financial markets are entering one of the most important moments of this cycle. Investors across the world are watching the Federal Reserve closely because the Fed's next move has the power to reshape stocks, bonds, and economic confidence. This is not just about interest rates anymore. It's about direction, timing, and how long the Fed is willing to hold the line in a fragile economy. Over the past year, markets have lived in a state of constant uncertainty. Inflation has slowed, but it has not disappeared. Economic growth is cooling, but it is not collapsing. Employment remains strong, yet cracks are beginning to appear. This creates a difficult situation for the Federal Reserve because acting too early could reignite inflation, while acting too late could push the economy into recession. The Fed understands that every word it speaks moves markets. Even a small change in tone during a policy statement can trigger major rallies or sudden sell-offs. That is why investors are no longer focused only on what the Fed does, but on how it communicates its intentions. Markets move ahead of reality, and expectations often matter more than actual decisions. Interest rates sit at the center of this entire story. When rates rise, borrowing becomes more expensive for companies and consumers. Businesses delay expansion, households reduce spending, and corporate profits come under pressure. Stock valuations, especially in growth sectors, tend to fall in this environment. At the same time, higher rates make bonds more attractive, offering better yields and safer returns. But when the Fed signals that rate hikes are nearing an end, everything changes. Stocks often rally well before any actual rate cuts happen. Investors start pricing in future growth, lower financing costs, and improving economic conditions. This is why some of the strongest market rallies in history have occurred when the economy still looked weak on the surface. Technology and growth stocks are usually the first to respond to these shifts. Lower future rates increase the value of long-term earnings, which benefits innovative and high-growth companies the most. However, if inflation remains stubborn and the Fed stays aggressive, these same stocks can face sharp volatility, making risk management more important than ever. Bonds tell a different but equally powerful story. After suffering heavy losses during rapid rate hikes, bonds are now entering a potentially historic turning point. If the Fed pauses or signals a pivot, bond prices could rise significantly as yields fall. This creates an opportunity that many investors have not seen in over a decade. For income-focused and conservative investors, this environment is especially important. Bonds are once again offering meaningful yields, and locking them in before rates decline could provide stable income and capital appreciation at the same time. Large institutional investors are already positioning quietly, long before headlines catch up. One of the biggest mistakes retail investors make is reacting too late. Markets do not reward certainty. By the time the Fed officially changes policy, much of the opportunity is already gone. Professional investors focus on probabilities, not predictions, and adjust their portfolios gradually as expectations shift. Another overlooked factor is the global impact of the Fed's decisions. A more flexible Fed usually weakens the U.S. dollar, supports international markets, and increases global risk appetite. A stronger dollar, driven by higher rates, tightens financial conditions worldwide, affecting everything from emerging markets to commodities and global trade. This is why the Fed's next move matters far beyond U.S. borders. Capital flows, currency valuations, and international investment trends all respond to American monetary policy. What happens in Washington echoes across global markets within minutes. For investors navigating this environment, preparation matters more than prediction. A balanced portfolio that includes quality stocks, bonds, and some cash provides flexibility. Focusing on strong businesses with healthy balance sheets reduces downside risk. Patience becomes a competitive advantage when markets are driven by emotion and short-term noise. History shows that the greatest opportunities often appear when uncertainty feels uncomfortable. The Fed's next move may not look dramatic in real time, but its long-term impact could define market trends for years. Those who understand the signals early and act calmly tend to benefit the most. In times like these, the goal is not to guess perfectly, but to stay informed, adaptable, and disciplined. Because when the Fed finally makes its move, the market will already be moving ahead of it,